alternative investments, alternative strategies, and hedge funds. The demand for alternative investment products and investment strategies have clearly accelerated in the last couple years in the aftermath of the financial crisis. Portfolio diversification among the traditional asset classes failed to deliver the expected downside buffer. Now, investors and advisors are seeking products that offer correlations that won't compress with traditional classes, and investment strategies that will offer a counterbalance during market declines. In this module, you will explore alternative asset classes, alternative strategies, and the investment vehicles currently available. By the end of this lesson, you should be able to discuss the different types of alternative asset classes and their role in an investment portfolio. Describe hedge funds and conduct due diligence, and understand how to access hedge fund-like strategy through public mutual funds and exchange-traded funds. The traditional 60-40 mix, 60% equity, 40% bonds and cash, is typically considered the default traditional asset class allocation. Investors with a more aggressive risk tolerance, higher return expectations, and long-term horizons might merit an 80-20 stock-bond mix. The conservative investor with a short time until retirement, or in retirement already, might merit a 30-70 stock-bond mix. As depicted on this graphic, the three traditional investment asset classes are equities, fixed income, and cash, or cash equivalents. Note, for purposes of this discussion, we are considering equity in the personal residence as a separate asset rather than part of this investment portfolio mix. Alternative asset classes include collectibles such as art, antiques, gems, coins, commodities such as timber, or limited partnerships in oil and gas, currencies, derivatives like a managed futures account, inflation-adjusted securities, precious metals, private equity, private loans, real estate, perhaps active management in a real estate property, or international real estate, structured notes such as an equity-linked note, and venture capital. Alternative strategies might include shorting or long short, market neutral, futures accounts, option strategies, arbitrage such as convertible arbitrage, special situations like investing in distressed companies, and directional sector or country plays. You will learn more about these subjects later in the presentation. So why might you add alternative assets or investment strategies to your client's portfolio mix? The argument for inclusion of alternative assets within the traditional mix is clear. Improve portfolio diversification by adding low correlated asset classes to the traditional mix and possibly adding return, i.e. alpha. Adding alternative strategies can improve the portfolio's beta. You probably recall from your prerequisite course that the beta of a portfolio is the sum of the weighted betas of the individual holdings. The objective is to improve the entire risk-return profile of the portfolio. An added feature of alternative strategy is that you can introduce an element of leverage. So how do we get access to alternative assets or strategies for ourselves or our clients? There are numerous vehicles, including buy and manage the alternative asset or security yourself, private ownership, such as in a small business or in a real estate income property, through mutual funds, through exchange traded funds, limited partnerships, such as a venture capital, or hedge funds. Let's investigate now the world of hedge funds. Hedge funds have minimal oversight compared to investment companies. They are exempt from the Investment Company Act of 1940 because they are sold through private placement, limited to a small number of accredited investors, i.e. persons exceeding a certain level of net worth and or annual income, and offered without general solicitation to the general public. The rationale for minimal oversight is that the hedge fund investment is a sophisticated investment designed for sophisticated, knowledgeable investors, persons not in need of government protection when it comes to investments. Note that some hedge funds are able to accept a limited number of non-accredited investors if there is an element of high disclosure. As discussed earlier, the primary intent for participating in a hedge fund is to improve the overall risk-return profile of the portfolio. Adding alpha is typically secondary. As depicted on this diagram from the book Hedge Funds, Quantitative Insights, the intent is to shift that entire efficient frontier further into the northwest quadrant. The shift into the northwest quadrant results from adding assets or strategies producing low or negative betas to the traditional holdings. Notice in this RIDEX diagram the distribution of betas for a variety of traditional and alternative asset classes and strategies. This information is based on 2004 Ibbotson data. The mind map diagram on this slide depicts the variety of hedge fund strategies that are available. Let's examine some of these closer, specifically arbitrage, special situations, i.e. event-driven, long-short, and market neutral. Arbitrage is the active attempt to profit from mispricing opportunities. The focus might be on trading between futures and the underlying cash position, i.e. long one position, short the other. Purchasing one class of shares while selling another. Going long the convertible issue while shorting common shares, etc. Regardless of the hedge fund's manager's area of expertise, the intent is the same. Lock in a guaranteed or high probability gain as opportunities arise without taking on market risk. That's why the fund goes long one position and shorts the corresponding position. Hedge funds can focus on a variety of special situations, including bankruptcies and reorganizations, spin-offs, mergers and acquisitions, and Regulation D companies. Long-short strategy represents one of the largest segments of the hedge fund world. In this strategy, the hedge fund holds a combination of long positions and short positions. The rationale is simply to buy those securities that are poised for share appreciation, sell those positioned to decline. The mix between portfolio percentages, long versus short, can vary. A dedicated short bias fund will be weighted with more short positions. A short fund will be totally short securities. The market neutral strategy employs the long-short strategy as a way to eliminate market systematic risk. For example, the portfolio manager believes auto company A is well positioned and poised to gain in share appreciation. On the other hand, the manager has a less optimistic outlook for auto company B. The manager could purchase, i.e. go long, auto company A while shorting auto company B. The balanced position eliminates the sector market risk by just focusing on the relative price movements of the two companies. Hedge funds have high fees. Typically, in addition to a 1 to 2% asset under management fee, there's an incentive fee. The incentive fee could be 20% of profits in excess of a hurdle rate, perhaps the 20-year U.S. Treasury bond rate, or a high watermark if the fund had experienced previous losses and the fund is below its highest value. As noted, there may be additional costs including commissions, financing charges, and trading charges. Investment minimums are quite high compared to non-hedge fund investments, and a $1 million or higher minimum is not unusual. You should also note that there will probably be withdrawal restrictions. This is tied to the fact that hedge funds often take positions in illiquid securities. Therefore, accommodating unexpected withdrawals would place an undue burden on the manager and a financial handicap on other shareholders. As such, the hedge fund might allow withdrawals at certain times during the year or upon sufficient notice. Most hedge funds in the U.S. are structured as limited partnerships or limited liability companies, i.e. limited liability for the investor. Offshore funds are often structured as corporations. All income, expenses, gains, and loss for U.S.-based hedge funds flow through to the investor. Since hedge funds do not have clear disclosure requirements, i.e. non-transparency, it is very important that you conduct due diligence before making any investment for yourself or a client. Let's examine the concept of due diligence. First of all, there are many database providers of hedge fund information, including hedgefund.com, Eureka, Morningstar, Barclay Hedge, AltVest, TAS, etc. Please note all the names listed on this slide, and I am sure there are more. In order to be able to register for a hedge fund database access, an entity needs to be an accredited investor, SEC registered RIA, registered investment advisor, not state registered, or a broker-dealer. In selecting a database provider, it's prudent to evaluate the price of the service, the number of hedge funds reported, the accuracy and completeness of the data, and timeliness of the data. You might ask questions like, how often is your database updated? How many of the funds updated are done at that time? So what's the benefit of using a database? It allows you to screen through an extensive universe of funds based on investment style, strategy, fees, and performance, both absolute performance and relative. It offers fund contact and service provider information too. Remember, the database information is just the starting point from which you do further due diligence. Why? Hedge funds report voluntarily, and information can't be verified because the industry is not transparent. The diagram on this slide summarizes information I read in a Wall Street Journal article sometime in the late 90s that discussed how to select a hedge fund. Although concise, the article offered some useful recommendations. Specifically, understand the investment, including the prospectus, the investment strategy, the fee structure, and the withdrawal limitations. Compare hedge funds on an apple-to-apples basis, especially when you're looking at returns. Consider the tax consequence of the fund, and always do your homework, i.e. due diligence. Due diligence means putting on your analyst hat. You need to assess the fund's documents, its sales sheet, audited financials, regulatory registrations, and any informational or marketing brochures. Understand the funds and the management's history. Ask yourself, does this investment strategy make sense to me? Investigate the key personnel, their histories, their credentials, and most importantly, their ethics. Review performance data. And always check out the references. These might include investors in the fund, service providers, and auditors. You or your client will be investing a sizable chunk of money. Therefore, due diligence is a must. A fund of hedge funds is a structure designed to alleviate some of the burden incurred when committing yourself to extensive due diligence on numerous hedge fund candidates. That's because the manager of the hedge or the fund of hedge funds conducts the work. That person, who is supposed to be competent in conducting due diligence, does the legwork. The diagram on this slide from the textbook Hedges of Hedge Funds, How to Successfully Analyze and Select Investments, shows the difference between a single hedge fund and a fund of fund. Note that the manager of the fund of fund might select individual hedge funds across a range of strategies. This creates a multi-strategy fund of funds. Within a single strategy, creating a diversified portfolio of single strategy funds, or within different long and short strategies, perhaps even creating a market neutral fund of funds. The advantages of going with a fund of fund rather than individual hedge funds include professional due diligence of the individual hedge funds, professional monitoring of the hedge fund managers, perhaps smaller barrier to entries if there's lower dollar floors. Diversification. You're diversifying away from just an individual hedge fund so that you get rid of that business risk. A combination of investment styles can produce positive volatility return profiles, perhaps better liquidity, and the fund of hedge fund manager may be able to negotiate some better individual hedge fund fee schedules. Disadvantages of the fund and fund include due diligence still needs to be done when you're selecting that fund of fund. And here's the big one, an additional layer of fees. You already have the 1-2% AUM plus that 20% incentive fee. Now on top of that, you could be looking at 1% asset under management fee plus another 10% performance fee. Doing your due diligence on the fund of hedge funds is about the same as for the individual hedge fund. You should assess the fund's documents, its size, its fee structure. Understand the decision-making processes. How does the hedge fund manager decide on which funds to include? What risk assessments are being used? Consider the fund of funds track record in terms of asset growth, management consistency, and fund performance. And always check out the references, including SEC and anything available through NASDAQ. New investors typically buy into U.S. hedge funds and fund of funds at net asset value, NAV. However, some exchange-listed hedge funds, particularly those outside the U.S., may be offered at discounts or premiums, similar to the way closed-end funds trade. Notice the news clip on this slide showing how an exchange-traded fund of hedge funds had traded at a 30% discount during the recent discount to NAV during the recent market sell-off. The table on this slide summarizes the major differences between unregulated hedge funds and mutual funds, which are governed by the Investment Advisor Act of 1940, i.e. 40 Act funds. You will notice that hedge funds lack transparency and charge high fees, while the 40 Act funds are required to provide investors with full disclosure and have relatively low costs. Hedge funds can employ high leverage, buy and sell illiquid and derivative securities, and restrict clients to high net worth individuals willing to invest large sums. The 40 Act funds have strict limitation against the use of leverage, illiquid positions, and amounts of derivative positions. Clearly, these are two different worlds. However, the worlds are starting to converge. The good news for our clients is that the world of alternative investments and hedge fund-like strategies are available outside of individual hedge funds. Let's look at some practical implications. Alternative investment classes and hedge fund-like strategies are now available with through numerous mutual fund companies and exchange-traded funds. The securities achieve hedge fund-like results through replication, i.e. the same hedge fund strategy, through similarity, similar to a hedge fund strategy except for some reduction in leveraging, shorting, or derivative positions, right? Consistent with 40 Act fund rules. And indexing, attempting to track hedge fund-like returns and risk profiles. You can easily locate alternative mutual funds or ETFs through a fund finder. For example, Yahoo Finance or Morningstar, or on a fund's website by using search words like commodity, currency, future, long, short, ultra, arbitrage, market neutral, hedge, etc. Or by looking within category listings, for example, an alternative category or a specialty category. The diagram on this slide shows the list of mutual funds that I discovered after typing in the word long short into the Yahoo Finance search box. Notice the category label alternative or alternatives on the iShares page. As public demand for alternative investments and strategy grow, so will the list of available products. You can be sure of that. In this lesson, you learned about alternative asset classes, hedge funds, and mutual funds and ETFs with hedge fund-like strategies.